Whatever, Marcos. Okay. Ready for me to do my best impression of Marcos?
Oh my God, no, of course not. But go for it.
Segura! What's going on? How you doing? What, you said fine? Fine's not good enough. What do you mean fine? Fine's just like, okay. I'm not fine. How many movies you watch this weekend? I watched like 50 of them. None? You watched none of the movies? What the hell's going on with you? Are you nebulous or something?
Oh, that's so you said nebulous.
Dude, you used that in our meeting like 3 days ago. You were talking about like not sure about something, and I was like, oh my God, he's totally gonna use it. And then you used it, and I was like, I know this guy.
That's so good that you said nebulous. You used it okay. I
The
would have used it
recession is gonna be
differently.
nebulous. Okay. I really wanted to happen so I can win my bet. Number
Yeah.
50, Brett's gonna drink coffee.
Happy birthday to that 4-year-old right there.
Oh,
He loves watermelon. He loves cheeseburgers. So we got him both in cake form.
cheeseburger in paradise.
Look at that. That's his older brother next to him.
Nice.
All of his glory. Happy B-Day, Pax. Love you, kid.
Growing up too fast. Okay, welcome everybody to episode number 37, Tuck Your Chart. Brett Horowitz here with my wonderful colleague, Marcos Segura, my co-host. Marcos, this is going to sound odd coming from me, but I've got some charts today that seem to suggest there's some worries about a recession. I've been in the anti-recession camp, or at least not till next year. But there's some signs that like, maybe there's something up and there's something to what you're saying.
The truth shall set you free.
We'll see. So first, we're starting off with the fact that while the Fed, for the first time in like 100 years, or really the last year, did not raise rates at the last meeting, other countries have done the same thing and had a few months where they did not raise rates, but then found out that inflation was not dropping, and so they had to raise rates. So I'm a little concerned that that could happen here. So my first two charts here are one with the Reserve Bank of Australia. They went, I think, 2 or 3 months straight without raising rates and found out that, hey, inflation kind of increased a little bit. So now we got to get back on and pump the rates a little higher.
Crikey. Okay.
And Bank of Canada, second chart, did the same thing. No rates for several quarters. Inflation was not coming down. And finally, they had to raise rates. So I know the Fed has been saying, we're going to keep raising rates. The market has said, we think you're lying, you're done. And I'm worried that if they don't keep raising rates, maybe we're not done with this inflation issue.
Yes, I agree. So you answered my first question. Two things for me. Historically, it's always looked like, and this is just data, right? You have to get your Fed funds rate above the rate of inflation before you actually can break it. And not your upper bound or your lower bound, your effective. And right now, the effective is just over 5%, with the low bound being 5 and the upper bound being 5.25. So with the last print, again, the problem with this print is that it's backward looking at 5.3. That's a thing. But if you annualize the 0.4, what is that annualized? Because it's not
4.8.
obviously times 12.
4.8.
Huh?
4.8.
No, I know, but that's like that's an easy calculation. It's not it. So I'll call it 4.8. Call it it's 5. They're like right there, basically.
Right.
But not clearly over. So give me a 25 basis points hike. I get it from that perspective. Only problem is like the trend is your friend thing, and it's not even close. Like look at the trends and look at housing, especially because that represents 30% of CPI. There's less price pressure. It's coming down. It's rolling over. So right. I guess they're just really, really, really afraid of what you just said. They do not want to stop and then have to come back, because that would be terrible.
Well, let's take it to where this is. What does it mean for the average client and the average investor, right? Bank of England, I think today raised rates by 50 basis points. So it's not like we're talking about big magnitudes probably still left of the Fed raising rates. But if the market is wrong and rates still going up by 1, 2, 3 times where the market thought they were done, like you're going to have some people that were really optimistic that it's over and that good times are to be had for everybody. And now that puts even further brake on on lending and borrowing and spending and all those things that nobody expects to actually happen anymore.
Yeah,
So,
something else has to break. If you read all like the smart people, you go to Larry Summers, you go to the big banks, everyone's still waiting for something else to break, and it kind of would make sense if more than just, I don't want to call it a blip because banks going under is probably never a blip, but it does seem like this banking crisis at the moment is a little bit behind us. We'll see what new regulations with shoring up bank capital come out of this, which obviously will be restrictive to economic growth also, right? Which help dampen everything. But I also, from an expectation perspective, and I think we're doing this in all of our meetings, the next 10 years, you should just expect a higher, just kind of baseline rate of inflation.
yeah, higher for longer, right? That's what
Yeah,
everyone's
that's
saying.
it. You should just expect that. And it makes sense with the reshoring of supply chains, with investment in quote unquote green technologies, and kind of building in all these economic redundancies and changing trade partners. It's just going to happen. And that's okay. It's not a chart I have, but in the 1970s, it was crappy when you had 7% inflation and markets did 5%. But then in the 80s, you had 5 to 7% inflation and markets were up 17%. So just because inflation is not 1 or 2% doesn't mean that companies are not going to do what they do, which is make money and find a way to be productive over time.
So that doesn't really help though the 90-year-old client that it's not going to have 2 decades to cover from. But
oh no, I hear you, but the reality is if you look at a balance sheet, you have some real estate on there, you have portfolio. Like, does sitting in cash beat a 7% rate of inflation? No, it didn't. There's ultimately kind of nowhere to hide. And if you find the one thing, what are you gonna do? Allocate all your capital to one thing? We know we're not gonna do that, right? So you can also make a case for the 90, 95-year-old is inflation's not a problem for you anymore. It's preservation of capital.
yeah,
Right? That's what you can't do. So I don't have time for it to recover type thing. That makes a lot more sense. And look, if you don't have the stomach for it or your assets aren't going beyond your own life expectancy, then yeah, take some risk off the table. I think that's reasonable.
well, the other thing that makes me nervous is something that I had never heard of before. And there was an article about it called the M score.
Okay.
And the M, as we both know, stands for manipulation. And
Oh,
no, you do
look
not
at
know that.
you. I was like, all right, let me get my stats book out because what the hell is he talking about?
So the M score was basically a gentleman named, I'm going to screw up his name. His name was
Binish.
Masad Binish. Binish? You said Binish?
I would guess Binish.
I don't know. So apparently he's created the score in the 1990s, and it's basically looking at 8 ratios of a company of 2,000 companies and looking to see how these ratios are changing. And there are things that could cause it to change, like if more receivables are on a company's books, like they've sent out the orders but haven't received the money yet. Or another flag would be if they report higher assets of value sold, but they don't have anything that's showing up yet on the sales report. Or lots of accruals where expenses have been incurred but not yet paid. So it doesn't mean that these things by itself mean a company is manipulating, but it could be a sign in totality that sort of things are worse out there and companies are finding ways to manipulate their ratios and their books to make things appear better than they are. And apparently this guy predicted this before Enron, found these issues with Enron, and 3 years before Enron went under, saw that Enron had all these weird discrepancies in their M score. But what it does show, and that's only one time, so I can't say that like it's going to work every time.
Okay, good. Thank you.
What they have found though is that as the M score goes up, as these ratios that are sort of nerve-wracking increase, more and more likely that there's a recession coming. So what are your thoughts on this? Anything? We go with this? I mean,
I have
it
no
seems to
idea
me
what this is. This sounds like hocus pocus, dude.
it does, right? It sounds like you got it to work one time in the past, and now every time going forward, now you think it's going to work.
This sounds like he was trying to replace an inverted yield curve. That's what he was trying to replace here. What's going on? So I'm looking at the chart 1980 to now. Recession's the gray bars like usual. So when it pops, this thing is signaling recession to come.
Well, it pops more often than there's recessions, right? So it seems like there's a lot of false positives too.
Well, yeah, that's kind of what I was getting to, right?
I don't go with this at all. I don't trust the M score to tell me a recession is coming.
Yeah, I don't know, man. Since 1980, we've had what, like 7 recessions. They just don't come that often,
No,
right?
but I like the fact that someone's looking out for companies that can be manipulating their data and doing
Well, yes,
something.
thank you, Jim Chanos. Hello, that guy's the man. Shorting is not all bad stuff. There's a shorting and looking for those things creates a healthy market. Okay, M score. I'm going to pay zero attention to it, but thank you for bringing it to our attention.
Yeah, and I don't think the M score is going to lead to recession because you know what? Recession is not coming. More people are
Oh,
getting on that bandwagon now. It's going to be a
yeah.
smooth,
No,
soft
I still go
landing.
Q4. I still go Q4. Okay, my turn. Bear market recoveries. Why do we want to talk about it? All right, like historically, it's taken about 19 months to recover from a bear market, right? 20% or more.
So time out. We need to let people know we just recovered from a bear market a few weeks ago, right?
Yes.
So we had a 20, what was it, 25% probably was the largest decline we had, maybe slightly more than that from,
No, it was 25% drawdown. That happened. We got to the 25 down October 12th of 22.
right. And since then, we've had a plus 20% to get us now out of bear market into now bull market.
Exactly. But out of bear market doesn't mean, oh, we're back to the highest number that the market's ever achieved. That has not happened, right? We've dropped 25. Actually, I guess we can look at this chart too at the same time. So I have this bear market recovery thing that I'll come back to. But on this bear market recovery thing, just all the way at the bottom there before the line, it shows January 22 to October 22, 10 months, 25% drawdown between those two time periods. Now, the length of recovery since October 12th of 22, it's been 8 months since that date. Has there been a recession called yet? No. Right. Okay. So on average, it takes 19 months to recover. If there's no recession, it's 10 months. If there is a recession, it's 27 months. We'll see what happens. But this basically says if we're looking at averages, we could take another year or so, right, to get back to the high from January 3rd of 2022.
It wouldn't be
Right.
so bad, right? Let's repeat that. The high, this is the all-time market high in January of 2022.
Yeah,
Right.
precisely. It was like right
And
around
that
the
was coming after a fantastic 2019, a fantastic 2020, and a fantastic 2021. So if we can get to that point and only a year from now, I'll take it any day.
Of course you will. And let's put some numbers to it. Number one, if you lose 25%, Brett, what do you need to recover? Right? Let's look at this other little chart I put up here. If you drop by 25%, all those red numbers are just showing you how big a portfolio drop would be, assuming a beginning portfolio value on the left over here. And at the very bottom, it shows you what rate of return you need to get back to even. So if you lose 25%, sorry, you don't need 25% to get back. You actually need 33% to get back to even.
Well,
Right.
this is why it's not good to be a perma bear. And it's not good to bet against the market because you need so much more on the upside to offset those downsides.
Betting
Like,
against the market doesn't make any sense unless you're Jim Chanos, right? And don't compare yourself to someone playing a different game. No one that I know is Jim Chanos.
yeah, but they have leveraged funds that you can say I want to bet on the market going down, and it could be 2 times the market or 3 times the market. Like those things just don't work because the market over time goes up.
Well, those are trading tools. Those are trading cards, right? And stocks are, in my perspective, you shouldn't view them like trading cards. You should view them as things to hold, right? Ownership in company. So we agree we've lost 25% from peak to trough. We need 33 to get back. If we assume generally an on average length of recovery, we're at 8 months in, it takes 19 on average. So a little bit less than a year from now, right? Let's look at this next chart. Equity scenarios.
July of 2024, new market high. You're calling it right now? Tell our listeners. Let's go.
Oh, wow. I didn't even do that because I'm not that guy. But you know what? Let's go to town, man. You said July of 2024?
Well, you said another 12 months, right?
Yeah, I was just going off on averages, though. You want to pin me down, huh? You want to pin me down on it?
You know what the future is because you watch this stuff all day for a living.
August? No, I'm not going to. Give me August. Give me September 1st.
Okay. I'm going to go with the under, hoping that it comes faster.
All right, good. You would do that. God, I got him. Good.
I want to root for that.
Wait, here's the point of all this, right? So let's assume it takes 2 years, Brett, to recover. So it'd be worse than what we're talking about. If it took 2 years from that low to recover, that would mean that you're annualizing at over 6% per year to get to that recovery point. If you recover in a year, that means you're earning just shy of 11% in US equities over that period of time. So assuming we all agree that markets are going to recover, now's not the time to try to sidestep things. Allow yourself to participate in the recovery that comes after what we already got in, which is the crappy part.
Yeah, but wouldn't you say that there are a lot of people that look at that number and say a 6.2 is fine, but I can make 5% in a money market or CD without any risk?
No, you
Why
won't.
would I want to earn
No, you
6
won't.
with stock risk?
Because over a course of 2 years, that 5% yield on your money market is not going to be 5% the whole time. That's it.
Sure.
Flat out. Okay, fine. Marco said, I won't do the money market. I'll buy a CD. So I lock in my return. Okay, fine. What is a 2-year CD paying right now?
Less than 5.
Done.
Yeah,
there you go.
Right. So
you can't get away from the risk reward thing, dude.
I have clients though that have said I want to buy a CD for 1 year because I get a higher return than 2 years. And so I had to explain to them the reason that it's higher than 2 years is because the market expects rates to go down. And if you buy 2 1-year CDs back to back, it should be the same as buying the 2-year because the market expects that over time that will end up being the same. Like there is no, I'm gonna take advantage of this and buy the 1 year and make out more, right?
Oh.
Because the second year be so much less.
Yeah. You're gonna make less money investing in cash-like instruments. That's just how that works.
Unless the Fed can't get inflation under control, and now we peak at 7 or 8% or even higher.
Yeah, it could happen.
The jobs numbers keep coming up, and employment is just slightly higher each week, but not anything to write home about.
Okay, last chart here, and this is actually not my last one, but it's one of my last ones. Wait, is this the same chart? No, it's two separate ones. NBER, that is the National Bureau of Economic Research. This is showing the recession calls and when they occur relative to the actual start of the recession and the market bottom. And so this chart is for all of those who are thinking, I'll just wait for the recession to be called or to be over, just to have a little bit more clarity, line of sight, dust to settle. Things just seem a little bit too hectic, too many things going on. All the ways that people put into words the idea that there's too much stuff going on to be able for it to feel safe to invest. What we're looking at here is when the Bureau of Economic Research makes a recession call, it's obvious that the recession starts before the call, right? That makes sense. They have to call it after it starts. They can't predict the future. We all know that. So in that third little column there, all those numbers are positive, right? It's 4 months before, 11 months before, or median average of 6 months before they make the call, the recession's already started. Now, when does the market bottom? So here's where, okay, wait a second. I know when they're going to make the call. When does it usually bottom? And if it bottoms after their call, then perfect. Here's the problem. There's no consistency. The dispersion between when a market bottoms and when the National Bureau of Economic Research calls a recession, there's no rhyme or reason to it. The median's actually negative, meaning the market bottomed before they made the call.
I think if someone still takes that tack that they want to get out before the recession is going to happen, they have not been watching Talk Your Chart for the last year. So you've been making the same point over and over again.
Yeah. I'd argue it's probably the majority of the population, but yes, you're right.
Okay, one last chart before we wrap up here.
Yeah, what is this one before? Lackluster stock market. Yeah, look, this is just again performance, looking at recession start dates, recession end dates. 12 months before recession, what's it look like? 6 months before recession, what's it look like? This one I kind of threw on there just for people to have to look at. What do you surmise from seeing this?
S&P 500 index gains lost before start of recessions. Now there's just no data of any kind of a pattern, right? I mean, I think we're all looking for the pattern. We're always kind of find out if there is one. Everyone's seeing other people do stuff. Does that represent a new pattern? Like this tells you, like, just got to be in it over time, because You can't tell the same story over and over again. Each one has different reasons for happening, how it ends, why it starts. Like, it's just all data.
Yeah, dude. Think of stocks as something to hold, not to trade. You know what this makes me think of? That a recession started on my birthday in 1973. Look at that. It also shows me how terrible the tech bubble time was with, look at the returns for 12 months before, 6 months before, and 3 months before. There was a lot of stuff going on, I guess, during that tech bubble, because it was Enron, there was WorldCom, there was a tightening cycle of the 90s. There was so much crap going on.
Yeah, my career started then, so it's been a very volatile 23 years in the business between that and the Great Recession and COVID.
9/11 too.
Yep.
Man. Yeah, that
Okay,
was
well,
no
things
fun.
are getting better. We're now in a new bull market, and let's hope that that continues and the recession doesn't happen. And Brett's right, and Marcus is wrong.
Yeah,
Even
exactly.
though we'd be sad that you lose your bet, but we want
I
that to
know.
happen.
Oh, last point, market concentration. Market's always concentrated since 1980, since like 2000, it's always well above 20%. The top 10 make up. The fact that they're carrying the market is not weird. And contrary to what some people are saying, you can take the other side of the coin and say, you know what's going to keep the rally going? When all those other names that haven't participated in the current rally year to date begin to rally themselves.
Okay, so homework assignment, you bring a chart showing that next time.
Okay, I'll have you make it for me. Thank you.
All righty, have a good one.